Hello and welcome to the latest Wealth of Advice market update filmed on the 7th of February. Chris has asked Jordan and myself to cover January's performance and have a look at the markets. We recently hosted our annual client seminar and had 100 clients come along to the Riverside Cricket Ground. Those who attended or watched the recordings have heard updates from Rathbones, T. Rowe Price and Elston. Inflation and interest rates were key areas discussed by all fund managers, and it's still these topics that dominate today's market update. Following a challenging 2022, markets have started 2023 in recovery mode, with global equities positive in January. Emerging markets have benefited from China reopening, interest rates peaking and a stronger than expected economic backdrop. We have not yet seen the full impact of 2022's aggressive rates tightening cycle. This could be something to watch through the corporate earnings seasons to see the impact on company profits. As long as US economic activity remains resilient, the Fed will remain confident in holding interest rates higher for longer to ensure inflation is brought back under control. European Central Bank Chief Christine Lagarde warned of further significant rises to come in order to get inflation back within acceptable levels. Again, it is inflation which is dominating the news here. EU manufacturing and services sectors have performed better than expected in January, keeping hopes alive that a soft landing might be achieved in Europe rather than a harsher recession. So what is a soft landing? A soft landing is definitely a buzzword for 2023 investment markets. Recession in the US, UK and Europe have been priced into markets since last year. However, with a soft landing, the impact of a recession would be less. To use the plane analogy, the Bank of England in the UK and the Central Bank in the US are trying to safely land the plane, with a soft landing the targeted outcome. I'm now going to pass you over to my colleague Jordan, who's our Head of Investment Research, to give you a bit more of an update on the UK and the US.
The Bank of England have raised interest rates another 0.5%, which takes rates in the UK up to 4% now. The Governor, Andrew Bailey, suggested that rates are nearing a peak and will only continue to rise if there's signs that inflation will remain high. In last week's speech, he announced that the central bank's estimation of a recession in the UK could be shorter and less severe than previously thought. This is obviously positive news for the UK economy. As you can see from this chart, the purple line is the central bank's current projected pattern for this recession. As you can see, this looks as if it's less severe than previous recessions that we've had in 2008, 1990, 1980. This demonstrates potentially a shallow recession that's going to happen in the UK. Markets reacted positively to this news that the UK may face a shallower recession and that interest rates look to be close to peaking. The FTSE 100 recently hit a new record high last week on Friday, surpassing its previous record high levels in May 2018, as you can see from this chart that was shown. FTSE 100 index, as many of you will know, is made up of global companies, not just companies who operate in the UK. About 80% of the FTSE 100's earnings comes from overseas. One of the reasons that the FTSE 100 is performing so well right now is not particularly to do with the outlook for the UK economy. It's more to do with pound sterling being weak compared to the US dollar. Lots of companies in the FTSE 100 produce overseas earnings which is paid in dollars. That kind of helps explain one of the reasons why the FTSE 100 is performing so well. We feel it's always important to retain a long-term outlook and be diversified across many stock markets, rather than just looking at the one market which is performing best at any certain time. One of the slides that clients will always be familiar with, which we'll show again towards the end of this update, shows how different stock markets have performed over the long term. That's one of the reasons we think it's so important to remain diversified rather than looking at one certain indice. Moving to the US, the Federal Reserve have raised interest rates another 0.25% as well. Federal Reserve Chair Jerome Powell said that inflation data received over the past 3 months shows a welcome reduction in the monthly pace of increases. The US Fed has 2 key mandates. One is to keep unemployment low to help the labour market, and 2, to bring inflation back under control. Positive news that US employment remains strong despite the slowing economy. Some sectors, like the tech sector and car manufacturers, tend to be more sensitive to rising interest rates. You may have seen recent headlines that there's been over 70,000 job losses reported in some of the largest tech companies in the world, such as Google, Amazon, Meta, which is Facebook. This has all happened over the past year. However, overall, 517,000 jobs were added to the US market in January, and US unemployment has fallen to 3.4%. There is some school of thought that we might potentially not see unemployment rise as high in this slowdown compared to previous recessions. This is potentially due to the fact that coming out of COVID lockdowns, sectors such as hospitality struggled to really find employees. There was many big name companies in America actually offering new employees a starting bonus just to come and work for them. This is one reason why unemployment might not rise as high if companies are feeling like they need to try and retain as many employees this time round. Talking about the US Federal Reserve's mandate of keeping unemployment low, bringing inflation down, this is exactly what Matthew was talking about, of trying to achieve a soft landing. If the US Federal Reserve is able to get inflation to come back down without unemployment rising too highly, that'll be considered a success for achieving a soft landing, potentially avoiding a worse recession. So, inflation has obviously been one of the biggest stories in markets over the past couple of years. You might remember this story here from 2 years ago when the Evergreen ship ran aground in the Suez Canal. At the same time, in 2021, there was many container ships all over the world stuck outside ports, stuck at sea due to lockdowns. This all had a huge impact on traded goods. At one point in 2021, it cost over $20,000 to send one shipping container from China to the US. Now, the cost of sending a shipping container that same way is down 93% to pre-pandemic levels, as you can see. Now, you might wonder why this is important. 90% of traded goods travel via sea. 11 billion goods a year, that's $14 trillion per year. Free-flowing trade is one of the reasons why goods price inflation looks likely to keep falling throughout the year.
Thanks, Jordan, for those interesting updates. We now move on to look at the wall of worry. This is a timeline of negative world events plotted alongside market performance. As you can see, there's some very significant events that are shown on this chart, but actually when you zoom out, you see that long-term investments do tend to trend upwards, and it's all about time in the market rather than time in the market. When we move on to look at market performance in more detail, we can see stock market indices over the last month. Again, as we mentioned earlier, it's positive that all these indices are trending upwards, and as you can see, we've had a nice finish to the end of the month there. When we look at stock market indices over 1 year, we know it's been a volatile time, and this chart very much shows that there's a lot of noise and there's lots of volatility shown. One thing that we've done here is we've taken this out and said, actually, if we check these indices on a monthly basis, what would that chart have looked like? And here we go. This shows that actually the analogy of look less, worry less definitely comes through in the data over the previous year, and it's positive that the FTSE 100 has obviously started the year particularly well, but actually it's about those long-term investments being held, which is why we move on to look at the stock market indices over 5 years. As you can see, the S&P 500 is up over 85%, the MSCI World there is up 64%, and the FTSE 100 is just over 28% there, which again is why we favour diverse portfolios with that equity content to drive returns over the long term. I hope you've enjoyed listening to this market update. As always, if there's anything that you would like us to cover particularly, please send a message, and we look forward to speaking to you again soon.